Property taxes in Oregon are weird. In this video, I'm gonna unpack what you can expect to pay for property taxes at closing when you purchase a home in Oregon. And there are some head scratchers that are fun to understand, but more importantly, I wanna save you from a potential rude surprise. This stuff is weird and it can get a little complicated, and if any of the details aren't figured just right, you could have a surprise bill at closing. So let me walk you through what to expect so you don't get caught off guard. And before I get rolling, I want to mention that this video is part of a playlist about property taxes in Oregon. In other videos, I cover what you need to know about taxes while you shop for a home and going forward as a homeowner. So check them all out. And while you're clicking around my channel, please take a moment to like and subscribe. And if you're looking for help with a loan, my contact information is in the description and I'd love to talk. So let's dive in. Some key dates drive a lot of what's to follow. The fiscal year for taxes in Oregon is July 1st to June 30th, and the due date for property taxes is November 15th. That's a little random. My pet theory is that November 15th was Oregon's first tax assessor's birthday, but wherever the date comes from, by the time taxes come due, we're about 4.5 months into the tax year. And the taxes that you pay at closing are going to fall into 3 categories: prorations, escrow deposits, and hold-in pay. You may only pay 1 or 2 of these, and they're not always labeled clearly, but keep watching. I'll unravel what's behind each item, and I'll show you exactly where to spot each one on the documents that your lender provides. And then I'll walk through some examples and share a shortcut you can use to make sure you're planning around an accurate amount at closing. So let's get started talking about prorations. Assuming your offer is written on the standard Oregon sales agreement form, there's a specific section that covers prorations. The form changes every so often, but while I'm recording this, it's section 26, line 302 and 303, which reads, rents, current year's taxes, interest on assumed obligations, and other prepaid expenses attributable to the property will be prorated as of select one, and you and your broker will check a box selecting either the closing date or the date you get possession of the property. Most of the time this will be the closing date, which means that you've agreed to pay taxes for the days that you own the home, and the sellers agreed to pay taxes for the days that they own the home, which is fair and logical and makes sense. Now there are 3 possible scenarios for how your prorations will play out at closing. The seller owes money to you, you owe money to the seller, or nobody owes anybody anything. So let's talk about that last scenario first. There is one and only one day of the year when the prorations are 0, and that's July 1st. If you close on July 1st, you nailed it. You closed on New Year's Day for taxes. When your tax bill comes due in November, the period it covers perfectly coincides with the day you got your keys. But what if you close on any other day? Now you and the seller have to square up with one another. If you close on any day from July 2nd through November 14th, your seller owes you a credit. Come November 15th, you'll be paying a bill for the tax year that started back on July 1st, and you didn't own your house yet. So the seller owes you a credit for each day from July 1st to your closing date. Now, if you close between November 15th and June 30th, you owe a credit to the seller. The prior November 15th, the seller will have paid taxes from July 1st to the upcoming June 30th. So you'll pay the seller back for each day you own the property from your closing date until June 30th. Another way to picture this whole proration business is to kind of imagine that you and your seller went out to dinner and the bill for property taxes is the tab. Whoever owns the home on November 15th is going to pay the bill. So to split the tab, one of you has to pay the other one back. If you close between July and November, you're the one paying the full tab. And at closing, the prorations are kind of a Venmo from the seller for their part of the bill, which is from July 1st to your closing date. And if you close after the seller pays the check for the year in November, then your prorate is kind of your Venmo to the seller for your share of dinner or days of taxes, really, from the closing date until June 30th. So here's where to go looking for these fees on the documents your lender provides. you get 2 official documents from your lender with all the fees. The first is a loan estimate, which will come within 3 days of your application, and then later, as you get closer to closing, you'll get a closing disclosure. If your closing is July 1st, remember there's no proration defined. You close on the first day of the tax year, so you won't see a proration on these documents. But if you close between July 1st and November 15th, the seller is going to pay you a credit. And this can be a little tricky to spot on the initial loan estimate, but if you scroll to the bottom of page 2, where there's a section called Calculating Cash to Close, you'll see a line that's just called really generically Seller Credits, which includes a few things. So you're going to have to ask your lender for an itemization of this number to see if the prorate is included. If it's missing, you're going to have a little less money due at closing than what they've estimated. Now, if you close between November and June, the prorates are a lot easier to find. Look on page 2 again, but this time up under Other Closing Costs. In section F, there's a line for property taxes, and the amount you owe to the seller should be there. If this credit is missing, and it is missing pretty often, you need to plan for a little more money due at closing than your lender has estimated. Now, as you get closer to closing, your lender's going to send you a closing disclosure. And the prorates are infinitely easier to spot on this document, or at least I think the labels are a lot more intuitive. If the seller owes you a credit, it'll be on page 3, line L13, under the heading Adjustments for Items Unpaid by Seller, which makes sense, right? This is a credit to you for taxes unpaid by the seller. And the amount you get as a credit from the seller is a cost to them. So you'll see over on the seller's side of the CD a mirror image amount. Now, if you owe the seller, the amount you pay will be up on line K9 as an adjustment for items paid by the seller in advance. Again, the language is more logical here, and that's mirrored by a credit on the seller's side of the settlement statement over on the right. Now that you and the seller have squared up for your supper, we get to move on and talk about the second category of taxes, which is escrow deposits. Now, at closing, the majority of loans are set up with an escrow account. And you can think of this account as a little sidecar savings account that runs along with your mortgage. Every month, you write a check for a payment that includes the loan, but also taxes and insurance. But the taxes and insurance that you're paying monthly are due annually. So the tax and insurance part of your payment has to have a place to kind of hang out, to live while it waits for the bill to come due. And that's the function of your escrow account. The tax and insurance peels off of your payment each month, gets deposited into the escrow account, and that builds up a balance. And then when taxes and insurance come due, your mortgage company dips into the escrow account to pay those taxes and insurance on your behalf. Now, like most things, taxes and insurance tend to go up every year, so your escrow needs to be set up with a little cushion to absorb these anticipated changes. The standard cushion, the standard target that lenders aim for, is to have 14 months of the previous year's tax bill in the account by the time the next tax bill comes due. And that bill is going to come out in October, like I mentioned before, so about a month ahead of that November due date. At closing, your lender is going to work backwards and figure out how many months of payments you'll be depositing into your escrow account between your closing date and October. And at closing, you're going to make an initial deposit to that escrow account to get it synced up with the tax year. Finding your escrow deposit on your loan estimate and closing disclosure is easy. On your loan estimate on page 2 under Other Costs, there's a section just for your escrow deposit, section G. Taxes have their own line item in this section right here. On your closing disclosure, you'll see the escrow deposits for taxes under Other Costs on line G3 right here. So let's talk about our third and definitely the weirdest element. This is only applicable if you buy a home in September or early October. If you do, things get a little weird and funky. As the due date for property taxes approaches, the county will file a lien against your new home-to-be for the taxes they plan to collect. And when this lien is first filed, really unhelpfully, there is no dollar amount attached to it, and even more unhelpfully, the county won't accept payment for it. Now, lenders care a lot about liens. You're about to borrow a huge sum of money, and your lender wants the security that if you don't pay, they have your home as collateral. And if someone else has already filed a lien on your property, already got there and filed that lien supersedes your lender's lien position. And we lenders don't like this. So before closing, every lien has to be paid to clear the road for your new mortgage to be in first lien position on your new home. So a lien for an unknown amount that's due to an entity that isn't willing to accept payment poses a bit of a challenge. And lending in Oregon could theoretically come to a screeching halt. It could just be at a standstill every fall, except for a clever workaround, which is this thing we call a hold and pay. If your loan closes during this otherwise problematic window of time during the year, the title company actually comes to our rescue. They act as a go-between, collecting money for this year's taxes, holding the funds on your behalf, and then paying the bill as soon as it's available with the county, and the county's finally willing to accept payment. With the title company standing in and not actually incidentally also providing a title insurance policy that states that your mortgage will be in first lien position, your lender feels warm and fuzzy and groovy about closing with this lien dangling out there that isn't yet paid. But we still have this other problem to solve, which is that we don't know how much the tax bill will be. So to solve this part of the puzzle, the title company just collects more than they know they'll need. The exact amount that they collect varies a little bit from year to year based on the expected changes to taxes, but 115% of the previous year's bill is really pretty typical. So at closing, the title company is going to collect more money than they know they're going to need to cover the tax bill, hang on to it, and then when the county gets around to issuing the bill, the title company nabs the bill and pays it with this money. And then once they know the actual amount of the bill, they can issue you a refund check for the extra amount that they collected from you at closing. So sometime in late October or early November, you'll open your mailbox to find a check from the title company. And you've been packing and moving and painting and totally distracted, so by the time this check shows up, you have probably entirely forgotten it was coming, so it's a nice little surprise, and you can go have dinner out with your windfall. Although I should mention one important caveat. If you manage to talk your seller into paying 100% of your closing costs, the refund check is actually going to go to them and not you. But if you talk the seller into paying all of your closing costs, maybe don't begrudge them their dinner out. Now, on your documents, the hold and pay is going to show up on your loan estimate on page 2 in the other closing costs section, F for prepaids. And on your closing disclosure, the hold and pay should be on page 2 under other closing costs, again, section F, line 4. And somewhere in section B or C, you'll probably also see a $60, $70, $80, $90, maybe $100 fee from the title company for administering this hold and pay. That'll be called something like a tax payment service fee or something else along that line. Now, let's talk about how all of this plays out, how all of this comes together by working through a few examples. And for these examples, it's good to know that your first payment on your mortgage is generally due the first of the month after you close. And if you're curious to learn about why this is and an exception to this rule that can reduce how much money you have to pay at closing, check out the video that I link above. But for purposes of this conversation, let's stick with the rule and not the exception. So first, let's see what happens if you close July 1st. As we talked about before, that's New Year's Day for taxes, so you and the seller are automatically squared up and prorations will be 0. But what about that escrow deposit? So with a July 1st closing date, your first payment on your mortgage is going to be due September 1st. That's the first of the month after closing. Now, we know the tax bill is going to be issued in the middle of October, so between closing and October, you'll write 2 mortgage checks. Your first check, your first mortgage payment on September 1st, and your second check, your second payment on October 1st. So that'll put 2 months of taxes into your escrow account. And then along comes the tax bill. And we want 14 months of taxes in the account. And with just 2 months coming in from your monthly payments, you'll need to kick off your escrow account by depositing another 12 months of taxes in at closing. So now let's see what happens if you close. Let's move your closing date up to August 1st instead. So first let's figure out our prorations. When the tax bill rolls in the fall, you'll be paying it. November, the house is yours if you bought it in October, and that bill will be for the full tax year, which started July 1st, but you didn't close until August 1st. So the seller actually owes you a month of taxes, which will be credited to you at closing. Now what about that escrow account? So if you close on August 1st, your first payment will be due October 1st. And then like a week or two after that bill, or after you've made your mortgage payment, your tax bill is actually going to show up. And we want, again, to have 14 months in your escrow account, and you've paid 1 month in from your payments, so you need to deposit 13 months of taxes into your escrow account at closing. That 13 months escrow deposit minus 1 month of prorates from your seller equals a net of 12 months that you'll pay at closing. And let's do one more. Let's say your closing date is back on June 1st. So closing in June, the seller will have paid the tax bill way back in the prior November for the tax year ending June 30th. So if you're closing on June 1st, you actually owe the seller a month of taxes. Your escrow account will get a little more action before the tax bill comes due. With a June closing, you'll start making mortgage payments August 1st, and that'll put 3 payments, August, September, and October, into your escrow account before the tax bill shows up. With 3 months in your account, aiming for 14, you only have to now put 11 months of taxes into the account, into the escrow account at closing. So your total of taxes due at closing will be 1 month of prorations due to the seller plus 11 months into your escrow account, which equals 12 months. And by now you've probably noticed a pattern. Your prorations and your escrow deposit keep adding up to a year of taxes. And this is a handy shortcut. Most of the year, you'll pay between 11 and 12 months of taxes at closing. 12 months if you close early in the month. My examples were all closing the first of the month. 11 months if you close at the end of the month. And somewhere in between if you close somewhere in between in the month. But this pattern is going to break down for that part of the year if you happen to close during that funny hold and pay window starting in September and ending in early October. And for a closing that falls in that 40 or 45 day window, you can plan on paying probably 13 to 15 months of taxes at closing, but then remember that a portion of those extra taxes are going to be refunded to you. And if all of this pretty much makes sense, but you don't think you could repeat it back, that's okay. Your lender should estimate these things for you, but proof their work with what you just learned now and ask questions if your loan estimate and initial CD don't line up with what we've just talked about. And then before you sign closing papers, the endlessly helpful folks at the title company, they really are great and wonderful, will work out all of this math for you and the seller right down to the penny. Now, when I talk to clients about all of this stuff, the escrow deposits in particular generate a question that comes up really frequently and goes something like this. If I'm paying a whole year of taxes at closing, shouldn't I be able to skip paying taxes in my mortgage payment for that first year of payments? And I have to admit that, paying a year of taxes feels like a lot. It just feels like a ton of money, and you feel like you should be covered for a while. But no, you do have to pay taxes in with your mortgage payment right away. Now, this is a little bit of an oversimplification, but loosely you can think of the taxes that you're paying at closing as covering this year's costs, and the taxes that you're paying in your monthly payment as saving toward next year's costs. Or you might find it helpful to just picture the balance, because remember, your escrow account's a little savings account. So just picture it ebbing and flowing, right? As you pay in through the year, the balance builds up so that that money is there to pay the taxes and insurance when they come due. If you don't keep up with making those monthly deposits, the account won't have sufficient funds in it to cover your taxes the next time they come due. So to learn more about all the oddities around property taxes in Oregon, and there are more oddities about property taxes in Oregon, check out the other videos in this playlist. And if you're in the market for a lender, my contact information is in the description below. I would love to talk.